Good afternoon, everybody. Happy Friday and welcome to this week's weekly commentary. So for those of us that describe the sharp July technology and AI sell-off as a healthy reset, rather than the end of the bull market, so far this first week in August has given us confidence that we may have been correct. After the unwinding of momentum trades in July, we're seeing what could be a V-shaped recovery, especially in the areas that were hit hardest. And given the current earnings environment, it would be difficult, I think, for the bears to take control of this market. For the second quarter, average earnings growth was 31.1%, with 86% of reporting companies beating EPS estimates. Most have offered guidance for continued strong earnings growth in the coming quarters. I think that alone makes for a strong argument that this bull market, for now, remains very much intact. Now, much of this growth is being driven by the AI revolution, and while chips, servers, and networking have been the main beneficiaries of the nearly $750 billion of CapEx spending by these large hyperscalers, broad swaths of the economy are also benefiting. And this should continue to be a tailwind, I think, for years to come. Projections for cumulative CapEx spending through 2030 have been raised to $5.3 trillion. For 2026, this infrastructure build-out will represent roughly 5% of GDP. On its current path, this looks to become the largest infrastructure project in United States history as a percentage of GDP, surpassing even the Gilded Age's railway mania. Now, given the increasingly outsized role the spending will have on GDP growth and corporate earnings, I want to try to break down for you exactly where these dollars are going and why. So current spending flows through a stack of suppliers. The largest revenue beneficiaries, they're not necessarily companies building the data centers. They also include the companies supplying the expensive equipment that needs to go inside them. Now, the companies that I'm going to reference below, these are not to be taken as investment advice, rather it is informational. So AI chips are the largest beneficiaries, and NVIDIA has been the clear winner, selling GPUs, networking chips, and complete systems. Broadcom is another. They benefit as well, supplying custom AI accelerators, Ethernet switches, and networking chips. Next would be semiconductor manufacturing and equipment, which is seeing huge inflows. Now, when Amazon, Google, Microsoft, etc., when they design a chip, someone has to manufacture them. Applied Materials, Lam Research, KLA, among others, have been major beneficiaries in this area. Memory, too, has become an increasingly large share of each server as AI accelerators require large quantities of expensive, high-bandwidth memory, otherwise known as HBM. Micron, SK Hynix, Samsung, and others find themselves to be in the right place at the right time for this. Servers and racks are playing a growing role. Some cloud companies do build systems in-house, but many purchase finished servers or racks, benefiting companies like Dell, Supermicro, Hewlett-Packard, among others. Networking and optical connectivity matter because thousands of accelerators need to communicate at extremely high speed. So this is where Broadcom, Marvell, Cisco, and other providers expand this layer. Power and cooling infrastructure is less tech-heavy, but a critical category since AI facilities require far more electrical and thermal infrastructure than typical data centers. This category could prove more durable than some of the other layers of this build-out. Vertiv, Eaton, Siemens, and Johnson Control have landed huge contracts in this area. Construction and power generation kind of round it out. Construction and mechanical contractors, along with electricity generators, are in enormous demand. This is benefiting Siemens Energy, Caterpillar, and others. A simplified flow of money using, let's say, a hypothetical $100 of AI infrastructure spending might look something like this. $50 is going to go for accelerators, CPUs, and memories. $15 for servers, racks, and storage. 10 for networking and optical equipment, 15 for power and cooling structure, and $10 for buildings, engineering, and construction. Now, the exact percentages, of course, are going to vary significantly from project to project, but this illustrates how broadly the benefits can spread. The new data centers, I should say themselves, can be thought of as industrial scale computing factories. They convert enormous quantities of electricity into computation and then try to monetize that computation through cloud services, artificial intelligence products, advertising improvements, enterprise software, and capabilities that we haven't even thought of yet. So in the coming weeks, I do plan to break down specifically what these data centers are designed to do and how the economics work and how that may benefit various sectors of the economy as well as the overall economy. In the meantime, the economy continues to be resilient, although there are some signs of weakness a bit beneath the surface. Friday, today, the unemployment report was a good example of the market's sometimes counterintuitive bad news is good news scenario. I say that because the economy lost 23,000 jobs in July compared with an expectation for an increase of roughly 80,000. The unemployment rate actually edged down to 4.1%, largely because fewer people were participating in the labor force. Markets actually rallied on this disappointing news because the weaker employment report has now lowered expectations that the Fed's going to raise interest rates at its September meeting. The bond market likewise rallied as Treasury yields fell on the news. The employment weakness, however, was somewhat at odds with some of the other recent economic data. It's a bit of a mixed bag out there and a bit confusing sometimes, as U.S. manufacturing activity strengthened in July with the ISM Manufacturing Index reaching its highest level in more than 4 years, a very positive sign. In other news, the war in Iran continues to confound, although markets surprisingly seem to be largely ignoring the noise there. I read a joke recently where the Nobel Committee is preparing to award President Trump his long sought after Nobel Peace Prize, given that he's now ended the war in Iraq some 8 different times. While it appears that the war, however, is no closer to being over now than it was at any time since February, I think there is some method to the madness of the messaging. The higher the price of oil, the greater pressure on the United States and the West to conclude hostilities, likely, in that case, in Iran's favor. The longer oil prices stay stable, Iran loses that pressure point and loses leverage. I think this is why we regularly hear conflicting reports regarding negotiations. It's difficult which side is being truthful, if either, as both sides have motives for their rhetoric. Each time the president says talks are scheduled and the Iranians are begging for a deal, oil prices fall. The Iranians' response denying these talks is likely their effort to put upward pressure on oil prices. So I think the midterm elections may have a greater impact on the short-term direction of the markets, regardless of the outcome at the polls. It is because of the upcoming election that it may be unlikely that we see a full-scale, all-out military assault on Iran over the next few months. It's possible, though, that the president, through his rhetoric, is trying to maintain oil price stability, through the election. So if nothing is resolved prior to then, the most likely time for that all-out effort would be just after the election. That, among many other factors that are going on out there, is something that we're going to be watching closely, continue to digest, and continue to report on for you. In the meantime, here's hoping you all have a wonderful weekend.